I think that informs their recent moves, which basically are they've said that they will open, or at least the Shanghai Gold Exchange, which is completely under the control, incidentally, of the People's Bank of China. They've said that they will open a vault in Hong Kong, and they have also said that they will open a vault in Saudi Arabia. Why? Because Saudi exports a lot of oil to China. Saudis want to be able to trade yuan for gold and gold for yuan. I mean, quite obviously, because of their trade. And I think you may well see other ones, other vaults being opened. This is all part of the internationalization of the yuan. And then only, last week or 8 days ago or whatever, it was announced by the Shanghai Futures Exchange that they would open up the futures exchange in Shanghai to foreign participation. A foreign bank can deal on the Shanghai Futures Exchange at the moment, but it has to do it through a Chinese entity. That is all going to go. So, and this is obviously not just gold and silver, it's also base metals. There was the nickel problem, if you like, in London when a whole load of trades had to be cancelled by the London Metal Exchange. That was a bit over a year ago now. So they want to take control over all this, if you like, at least to their advantage. Now, I think that one of the points behind the internationalization, if you like, the mobilization of gold as part of a trading situation, if you like. I mean, trading not fixed at this stage to the yuan, but obviously trading alongside the yuan. At some stage, when the dollar really does start collapsing, I think you will find the Chinese are in a position to immediately announce a fixed exchange rate between the yuan and gold, in order to stop their own currency sliding along with the Western currencies, led by the dollar. This is all after President Trump's Liberation Day. I mean, bear in mind that the reaction from the Chinese was uncharacteristically quick. The first announcement that came out was that they were going to speed up the negotiations for a free trade agreement between China, Japan and South Korea. And then this was rapidly followed by President Xi visiting some of the leading ASEAN nations, which are basically the other nations, if you like, in Asia, in Eastern Asia. I mean, I think I can't remember, he went to Myanmar, he went to Vietnam, he went to Malaysia rather, and I think he went to Thailand as well. So now this was quick. Now I'm fairly sure that the conversations that he was having was really about very quickly establishing a plan B, if you like, when America, started raising all these tariffs, this tit-for-tat tariff sort of thing. China needed to protect herself. She needed to secure her regional market, if you like, and that's what that was all about. And so this move on gold, I think, is in some senses an extension of that. And I'm sure that President Xi would have said to some of the leaders in these ASEAN nations, we're quite happy to sponsor a gold vault so that we can trade in yuan and we can trade in gold, whatever you like. I mean, this would be particularly one of the countries he went to was Vietnam. Now, the Vietnamese do use gold for ordinary settlement. I mean, you buy a house in Vietnam, you use gold. So, you can see the links, if you like. I may be joining the dots too much, but to my mind, it is actually quite clear that there is a new world out there which we are not involved with, and it is based on Chinese yuan that will become the principal currency replacing the dollar. And at some stage, it will be guaranteed by gold. And that, I think, is very, very important to understand.
All right, so let's take a serious look at what's unfolding, because quite frankly, it's nothing short of extraordinary. You see, we're watching the deliberate construction of a parallel monetary world, one that's designed specifically to operate beyond the grasp of the US dollar system. And if you don't mind my saying so, it's absolutely brilliant from China's standpoint, even if somewhat terrifying from ours. Now let's start with the most recent moves, because they're quite telling. The Shanghai Gold Exchange, which I must remind you is under the very direct control of the People's Bank of China, has announced they'll be opening new vaults in Hong Kong and, here's the kicker, in Saudi Arabia. Now, why Saudi Arabia? Well, it's not terribly complicated. Saudi exports enormous quantities of oil to China, and quite logically, the Saudis would like to be able to swap yuan directly for gold or gold for yuan without the need to run it all through dollars or Western financial plumbing. It makes absolute sense from their standpoint, particularly as they look to diversify away from an increasingly unstable petrodollar arrangement. And I would wager this is only the beginning. I'd fully expect to see announcements of other vaults springing up, perhaps in Malaysia, perhaps Vietnam, perhaps Indonesia. This is all part and parcel of Beijing's grand design to internationalize the yuan, to slowly wean critical trade flows off the dollar, and to ultimately position the yuan as the settlement currency of choice across a vast swath of the globe. It's slow, methodical, and entirely deliberate. Then, almost simultaneously, the Shanghai Futures Exchange has come out and declared that they'll open up futures trading to direct foreign participation. Up until now, if you were a foreign bank and wanted to trade on the Shanghai futures markets, whether gold, silver, copper, or anything else, you'd have to set up shop through a Chinese entity. That's now going away. It means Wall Street banks, Swiss banks, Singaporean institutions can directly plug into the Chinese metals markets without intermediary structures. It's an enormous liberalization, and it's very much designed to funnel liquidity into Shanghai while tightening the screws on London and New York. Now, it's not just precious metals. Remember that fiasco with nickel on the London Metal Exchange about a year ago, when they brazenly canceled trades to protect certain powerful short interests? Well, Beijing noticed, that episode basically put a bullet through the LME's reputation. And who do you think stands ready to inherit that business? Shanghai, of course. They want to be the global hub not only for gold and silver, but for the entire base metals complex. It's classic strategic positioning. So we must look at this holistically. China is laying the groundwork for a world where the yuan isn't simply a regional currency or a means to pay for Chinese exports. No, they want it to be the principal global settlement currency, replacing the dollar over time. And they're doing it by building the infrastructure for direct trading, for physical settlement, for vaulting in friendly jurisdictions, all with an eye on the day when the dollar stumbles badly. Now allow me to speculate a touch, though I think it's well-founded. When that day comes, when we inevitably see a significant slide in the dollar's purchasing power or confidence, sparked perhaps by ballooning deficits or an interest rate spiral, the Chinese will be ready to announce a fixed exchange between the yuan and gold. You heard me correctly. They'll peg the yuan to gold. They don't need to do it now because they're quite happy to keep building reserves, to keep importing at these low Western-manipulated prices. But make no mistake, it's the end game. It all ties back to what I've often said. Gold is not really rising. Rather, it's that fiat currencies, dollars, euros, yen, sterling, are losing purchasing power. When people say, gold's up $300, that's a rather backward way to look at it. It's the currencies that are down. And right now, what's pushing that decline more than anything is the relentless accumulation by foreign institutions. It's not just that the People's Bank of China is buying gold. No, they're dumping dollars. They're actively diversifying reserves, which is the polite central banker way of saying they're losing faith in the dollar's long-term stability.
China started off with this, when Mao Zedong died. This thought, if you like, was behind the appointment of the People's Bank of China to act not only for all the foreign exchange transactions, along with the safe fund, which is sort of seen as a sovereign wealth fund, which is underneath the control of the People's Bank of China. But also in 1983, regulations were produced by the Communist Party appointing the People's Bank with sole control over the nation's gold and silver programs. And it was clear that with that big bear market that we had between 1980 and, this started in 1983, in effect, between then and the year 2000, 2002, there was a lot of gold coming out on the market. These were the conditions under which the People's Bank of China was able to accumulate substantial, undeclared quantities of gold bullion. By 2002, obviously, the People's Bank of China and the Communist Party reckoned that they had got enough gold to secure their currency in the future. And so at that stage, they opened the Shanghai Gold Exchange and allowed ordinary Chinese citizens to accumulate gold. Until then, they'd been banned from owning it completely. Since then, Chinese nationals have taken delivery out of the vaults, the SGE's vaults, of around about 27,000 tons. Some of that would have probably gone back in as scrap. Because anything which is resubmitted to the vaults, if you like, is scrapped and then recast. But on top of that, there is quite a lot of gold which is actually owned by banks and also ETFs and other investment funds, which are stored within the Shanghai Gold Exchange's vaulting system. So, we're looking at very substantial quantities of gold. And I reckon that by 2002, I reckon the state had probably accumulated around about 20,000 tons of gold. And also bear in mind that they invested a lot of time and effort into both refining gold and also mining gold. And they quite rapidly became the largest gold mining nation in the world. And have held that position for, 15 years now? It must be about 15 years. So, and the other thing is, of course, we've seen gold go from the west to the east. I mean, this was, a story which that's 20 years old, that story now. There's an awful lot of gold has gone into China. And not only that, but nothing comes out of China. I've spoken with directors of the Swiss refiners, asked if they ever see any Chinese refined bars, and the answer basically is no. There was a report of a few bars turning up, and it was thought that they was all smuggled out. But basically, it's Hotel California for gold. So there's an awful lot of gold, both owned by the state. And also owned, and not declared as reserves, incidentally, owned by the state and also owned by Chinese nationals. So how much it comes to, I really don't know.
Now let's look at the next leg of this, because the inevitable question is, what does this mean for Western investors, for savers sitting in dollars, pounds, or euros, for pension funds, for the man on the street? Well, the blunt truth is it means we're headed into a period of profound adjustment. That's a polite way of saying wealth will be violently reallocated from paper to real assets, from creditors to debtors, from passive holders of fiat to those holding something tangible, immutable, beyond the reach of central banks. And make no mistake, we are watching the slow-motion breakdown of credibility in the Western financial system. That credibility was never actually about sound money or prudent fiscal stewardship. It rested entirely on confidence. The confidence that the dollar would always hold roughly steady, that treasuries would always be liquid, that markets would always clear, and that the system would always bail itself out. What's happening now is that confidence is quietly evaporating. The rest of the world is no longer willing to play the dollar game. Let's drill into gold and silver specifically, because this is where the chickens truly come home to roost. For decades, we've had a completely absurd pricing mechanism, one in which the overwhelming bulk of the so-called price discovery in gold and silver occurs not through the physical market, but through leveraged paper contracts on the COMEX in New York and forwards in London. These are synthetic markets. They trade promises, not metal. A typical day might see 500 million ounces of silver traded in paper form, with total annual mine supply globally around 850 million ounces. Think about that. In a single day, they churn more paper silver than the planet produces in a year. The entire thing only works as long as nobody actually stands for delivery in meaningful volume. It's a fractional reserve system, just like banking. And when everyone wants their metal at once, there simply isn't enough to go around. And we can see the strains. Delivery requests on COMEX have surged to record levels. There's been a steady drain from LBMA vaults in London as well. We even hear anecdotal reports of the Bank of England taking up to 8 weeks to move metal that should be T+1. That's supposed to mean you trade on day 1, settle on day 2. That's what the rules say. But apparently there aren't enough trucks, or so they'd have us believe. It's beyond parity. These are institutions that once moved mountains of bullion during wartime. Now apparently they're defeated by logistics companies. Meanwhile, the very same dynamic is accelerating in Shanghai, except there the delivery means actual physical gold and silver changing hands. When they say stand for delivery, they mean it. Metal leaves warehouses and is vaulted under tight local control. And because China has been running massive state-backed campaigns to encourage its citizens to buy gold and silver, literally national television ads instructing families to store wealth in bullion, you can see where this is headed. They are quietly nationalizing global supply chains in precious metals by encouraging private ownership inside their own borders, then creating seamless infrastructure to settle major trades outside of dollars. This is what I meant earlier when I said there's a new monetary world out there, one we in the West are simply not involved with, and the asymmetry is profound. Now let's talk about volatility, because a lot of people ask, why do gold and silver swing so wildly? Why do they spike and then get smashed? You'll hear a lot of nonsense about risk-on, risk-off rotations. That's just financial media babble. What's actually happening is that volatility itself is used as a tool of suppression. These big banks deliberately engineer enormous swings within a range to keep investors off balance. If they can keep the price erratic, fewer people feel comfortable allocating serious capital. It's behavioral conditioning. And yet look closely at the pattern over years, not weeks. We're seeing higher highs and higher lows. It's a classic bullish staircase. That tells you someone with deep pockets is buying every meaningful dip. Who might that be? Well, look at the central bank data. Look at the sovereign wealth funds quietly shifting from bonds into bullion. This is not retail. This is not your neighbor buying 10 Krugerrands. This is structural. There's also a deeply underappreciated political dimension. Because as we drift closer to multipolarity, with the BRICS expanding, with the Shanghai Cooperation Organization growing more assertive, with the Belt and Road Initiative wiring Asia and Africa directly into China's trade orbit, the implicit threat to the Western monetary architecture becomes clearer. These nations are incentivized not only to reduce dollar dependency, but to actively build redundancy against the dollar crisis. Sergei Lavrov, Russia's foreign minister, recently announced that the BRICS cross-border payment system, a bridge network designed to circumvent SWIFT, would be offered to all non-BRICS nations. That is an absolutely monumental step. It's not just 5 countries anymore. It's an invitation to the entire global South, to any nation that feels nervous holding dollars or being subject to U.S. Treasury sanctions. In aggregate, if you tally up the Belt and Road participants, the Eurasian Economic Union, and BRICS Plus applicants, you're talking about more than 3/4 of humanity by headcount and over half of global GDP. That's an alternative settlement universe. Now let's overlay gold, because if China succeeds in anchoring yuan settlements with gold convertibility, even if informally at first, it instantly legitimizes the yuan as a stable reserve asset. In effect, they'd be offering something the dollar no longer does, a hard anchor, and the irony is delicious. The US went off gold completely in 1971, crowed about the exorbitant privilege ever since, but by abusing that privilege, by running endless deficits and weaponizing the dollar system, they've driven the world to build a gold-anchored alternative. It's a monetary tragedy of hubris. So what does this mean practically for gold and silver prices? Well, let's be candid. We have no honest pricing today. The futures markets are designed precisely to suppress runaway prices by flooding the market with synthetic supply. But history tells us such schemes fail. The London gold pool of the 1960s collapsed under far lighter pressures. When confidence snaps, when too many people demand real metal, the repricing will be brutal. That's how you get overnight gap-ups of hundreds of dollars in gold, or silver jumping by double digits in a week. And by the way, silver is the most fascinating asymmetrical bet on this entire transition. It's been heavily treated as purely industrial by China, by design, because they wanted to keep it cheap for their solar panels, electronics, missile guidance systems. But culturally, it's still seen as a monetary metal across Asia. The gold-silver ratio hovering around 90 is historically absurd. Even returning to a modest long-term average of 45 would imply a silver price double current levels. If we ever revert to geological ratios, silver is mined at roughly 7-to-1 to gold. Well, do the math yourself. It gets almost silly. Now let's address another common question. Why aren't generalist investors piling in? Why aren't pension funds buying bullion hand over fist? The short answer is career risk. Most institutional allocators don't understand or trust physical metals. They want yield. They're benchmarked against indices. Their incentive is to ride equities and debt. If they buy gold and gold goes sideways, while the S&P climbs another 10%, they look like fools. If they buy Nvidia or Apple, no one asks hard questions. It's a tragedy of institutional short-termism. That means this market is still largely driven by a mix of sovereign demand, ultra-high net worth families who understand intergenerational wealth transfer, and increasingly by the more alert retail investor. That's actually a huge opportunity, because by the time the giant pension funds do start allocating, when their boards finally panic about currency debasement or sovereign default risk, prices will be dramatically higher. They'll be the late money, as always. Let's also remember something from behavioral finance. Bull markets are designed to take the fewest along for the ride. They climb a wall of worry, volatility, and sudden sharp corrections are there to shake out weak hands. The majority of investors will only pile in after prices have made eye-watering gains, justifying the move with retroactive narratives. You want to be positioned before that. And finally, a practical note. Many people ask, what should we do? How do ordinary savers prepare? It's actually quite simple. Accumulate physical precious metals methodically. Don't try to time the market perfectly, you won't. Instead, average in over months or years. Take delivery. Store it outside the banking system. Think of it as insurance, not speculation. You're not trying to trade gold for a 20% gain. You're trying to preserve purchasing power through the greatest monetary reset of our lifetime. Because here's the raw, unvarnished truth. If you hold all your wealth in dollars, euros, or pounds, in instruments denominated in these currencies like bonds or domestic bank deposits, you are effectively betting everything on the competence and restraint of politicians and central bankers. How has that bet worked out historically? Exactly.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.